The Philippine economy grew at a slower pace in the first 3 months of the year thanks to higher consumer prices. The government reports a 6.4% expansion from January to March, the slowest after 7 quarters. The National Economic and Development Authority attributes the slowdown to high inflation. Let's now get the insights of HSBC Chief Asia Economist Frederic Neumann, joining us now live from Hong Kong. Fred, thank you so much for joining us. 6.4% first quarter growth. What's your assessment of this number? Within, below, or above HSBC's expectations?
Actually, it's better than expected, better than financial markets had penciled in. Yes, the economy is slowing, and yes, consumers are suffering due to higher prices and they're pulling back on spending, but they're still showing resilience, which is quite remarkable. And even at 6.4% growth, the Philippine economy is astonishingly resilient given the high interest rates and the high inflation that we have seen.
So with this number for the January to March quarter, Fred, is the economy normalizing or slowing down?
In many ways, it's slowing down from a very fast acceleration last year. We see that clearly in the data, but it's not falling below its long-term trend. Remember, last year was a particularly strong year, bouncing back from the pandemic-induced lows in demand. And so we are seeing a normalization, a slowdown towards a normalization, if you will. But make no mistake, there's some clues in the data here that perhaps inflation is not going to disappear very quickly. We might see actually more tightening on monetary policy just to stabilize inflation. Of course, that's bound to slow growth a little bit further. Particularly consumer spending over the course of this year could pull back a touch more.
You know, right now, the country, as you mentioned, is experiencing higher inflation, higher consumer prices. You have power outages, water shortages, and this El Nino phenomenon. Quite a number of issues that the economy is facing. Could these risks impact and stifle further growth in the Philippine economy in 2023?
They could. And in fact, it's likely that we see a further deceleration in growth. Still, the economy is resilient despite these shocks, but it's not going to rule out a slowdown. Also, what this requires to the shocks that you just mentioned are things that are likely to stay with us for years. They reflect climate change, for example, which is a big drag. And what that requires is more investment into infrastructure, whether it's energy, whether it's food security, whether it's making sure we have enough water supply, for example. That costs money, and we need to invest now. And fortunately, we have very ambitious infrastructure investment coming through, but we may need to see more of that in the coming years just to harden the economy against some of these shocks.
All right, we saw President Bongbong Marcos make more than 10 trips overseas in the first 11 months of his administration, and billions of dollars, more than $60 billion, Fred, in investment pledges. What kind of impact will these pledges or soon-to-be foreign direct investments have on the Philippine economy going forward?
Well, we need more foreign direct investment, and it's sort of the missing ingredient in the Philippine development story, if you will. There is a race towards grabbing more foreign investment. We have other economies in Asia, of course, seeing much more foreign investment. The Philippines has the potential to attract more, and we've always punched a little bit below our weight when it comes to attracting foreign investment.
Yeah.
Going out aggressively, courting this investment to come to the Philippines would be a major step up, and I think it would help to generate jobs, for example, especially if it's in export-led sectors. That's sort of the missing ingredient for the Philippine development story, and I think we're seeing positive signs of this starting to roll in.
You mentioned foreign direct investments, a missing ingredient. The one big factor that's lacking that could really push the Philippine economy forward. Why do you think is the Philippines suffering this kind of issue? Why do we remain one of the bottom feeders in Southeast Asia when it comes to foreign direct investments?
Well, there are hosts of reasons. One of the prime ones, however, is infrastructure. Infrastructure is often cited, the lack thereof, by foreign companies. Remember, if you invest in manufacturing, export manufacturing, electronics in particular, you need very sophisticated infrastructure. You need end-time supply chain management. You need very reliable electricity supply. And so the Philippines has the human capital, but it sometimes lacks the physical capital to capitalize on this. And that's why we see many Filipinos being very successful overseas in their jobs and their careers. But there are often lack of opportunities at home. And so bringing the investment home through better infrastructure is going to be a key step, I think, in accelerating that development process.
Apart from the issues that you mentioned, Fred, are investors also saying that the ease of doing business is difficult here in the Philippines? Also, graft and corruption?
That is something we face in many economies around the world. The Philippines is probably not an exception there. I do think over the years we've seen improvement in this regard as well. Certainly, the governments in recent years have done a lot to address this issue. But make no mistake, it is something we all wish was less thereof in many economies, but it's not the sole reason why the Philippines has not maybe attracted enough investment in the past. It does require lobbying for more investment, does require focus on infrastructure, and of course, ease of doing business, always something we can work on. But it's not as if the Philippines is entirely devoid of opportunities. In fact, there are plenty of opportunities from natural resources to export manufacturing to services, in fact, where we could still see very easily an expansion of foreign involvement in the Philippines. And I think in the next few years, we'll see an acceleration of that investment coming in.
And Fred, we've been talking about inflation being a risk to the Philippine economy, which is one of the reasons why we saw a slowdown in the first quarter of this year. But it has eased to 6.6% in the month of April compared to the other months, which is 7-8%. With inflation going lower, are we likely to see the central bank easing on interest rates, cutting interest rates to free up more liquidity, and which could boost the economy this year?
We need to be very careful not to cut interest rates too quickly because, yes, headline inflation, as you rightly say, is slowing down and might even go to the target of the central bank by year end. But core inflation is still very high, close to 8% almost. And so premature easing might be a bit of a risky strategy. We think that perhaps we want to wait a little bit before we start to slash interest rates again. We've done a lot of work to get prices under control. Let's keep vigilant for a few more months before we start easing back again.
And briefly, Finance Secretary Ben Jokno came out with a statement saying that with the 6.4% growth rate in the first quarter, we could see 6 to 7% growth for the full year in 2023. Is HSBC as optimistic as the Finance Secretary?
I think it's still achievable. Certainly the numbers today were an upside surprise, and there is tremendous resilience in the economy. We think that with the global economy slowing, maybe it's going to be a bit of a tall order to get into that range, but it's certainly within our grasp. And so the numbers today with better first quarter really point in that better direction.
Fred Neumann, thank you so much for your insights on the Philippine economy. HSBC Chief Asia Economist joining us from Hong Kong.